Hello everyone and welcome to this Smart Talk episode where we combined once again two of the Smart Talks to make it easier for you to understand. We're going to be talking about different ways to invest in crypto, how to figure out the value of a cryptocurrency, and then LSP will be going with a matter of perspective. This is when he had these main sentences and guidelines to follow when you're trading or investing in cryptocurrency, and he'll be explaining them quickly before going more in depth in the next episodes. So we'll be starting with the different ways to invest in crypto, and the investment possibilities are enormous. You have lots of stuff you can do with cryptocurrency. We'll go through the list right now, but for example, you've got stable coins, which are coins that are backed by an asset. So for example, on SwissBorg, you've got three of them: USDC, USDT, and DAI, and all of them are backed by US dollar. And there's also the Pax Gold, which is backed by gold. So these mean that if you go to the shop or to the headquarters and trade in your cryptocurrency, they will give you the physical asset. So it's actually backed by something. There's nothing behind it. It's not just lines of computer code. You've got cryptocurrencies, as we all know: Bitcoin, Ethereum, all of these, well, as I've said, line of codes that represent companies, system functionalities. They have purposes. Sometimes they have utilities, sometimes they're just fun, but cryptocurrencies in general, you know what they are, otherwise you wouldn't be there. We've got NFTs and games. So as we've talked about in the previous Smart Talk, NFTs are all of these pictures, videos that you can own. They're unique. You can invest in them as well by having one that's very scarce and will increase in value. You can also invest in stocks and ETFs. So crypto stocks and ETFs exist on the market. There aren't that many of them, but for example, we can consider that the Coinbase stock will move along with the success or downturns of crypto in general. So you could invest in Coinbase in the stock market, and that would indirectly be an investment possibility for cryptocurrencies. You can also invest in time and effort, notably with the SwissBorg DAO. You can invest in ICOs, which are new projects, so that haven't actually launched yet. They're still getting funds to exist, just like SwissBorg was. You can farm, you can use yield to basically just keep your crypto in one place and get a small interest returned to you every day, every week, every month. This depends on the company that's providing this service to you. You may also mine cryptocurrency, so allow a company to use your computer to mine cryptocurrency and be getting some in return. You can become a masternode, which is the person that's going to be allowing transactions. Basically a little bit like mining. You're going to be handing your computer power over to a company so that they can utilize it, make profits out of it, and give you a return on that profit. You'll also be able to stake, which is a little bit like yield farming. So you'll be keeping your crypto in a specific place, locked to have an asset or something provided to you in return. Generally, for example, in SwissBorg, it's not so much interest rates, it's going to be assets or benefits like the premium tiers. You can also trade cryptocurrencies. So instead of buying and holding on the long term, you can also play with the volatility and buy and sell with the short term graphs. And you can lend cryptocurrency, which is putting it in a liquidity pool so that other people can borrow, and then they'll be giving it back to you with the extra interest that you're getting out of this, because no one lends you money for free. So as you've seen, these are multiple ways of investing in cryptocurrency, and this list is non-exhaustive, so that means you can have more ways to invest, but these are going to be the main ones. And generally all of these are good ways to go. Everyone has made or lost money with every single one of these methods, and they're all advisable if you know what you're doing. Now next we'll be going to how to figure out the real value of a cryptocurrency, not the intrinsic value, because this is quite complicated with cryptocurrency, but we'll just be going over what are the important steps. And the first is going to be scarcity. How scarce is the cryptocurrency you're going to invest in? Can the company create more of it all the time? Is it limited? How many are there? Because if there's 10 of a kind or 5,000, it's not going to have the exact same value. So how scarce is the cryptocurrency? How secure is it? This goes without saying. If you buy and you get hacked straight away, it's not a great investment. Also, if it gets replaced by another company straight away as well, it's not a great investment. How safe is it? Is it backed by anything? Does it provide utilities? Which brings me to the next one. The actual utility. What are you buying? What does it allow you to do? Does it have a purpose? Is it just fun? For example, the CHSB will give you the premium tiers. This is your utility. In the future, we'll have the launchpad, so you'll be able to stake your CHSB to get other tokens in return. Can another crypto do that? This other crypto that you're buying, what does it do? Why is it useful? And how do you put a worth to that use? Community presence. How big is the community behind it? Is there a lot of people pushing the project up, or is it something empty with no one buying? Obviously, something with a lot of community presence will often have more success than something that has none. The cost. How costly is it to buy this asset? Are you going to be able to buy it for free or with very low fees, or is it going to be extremely expensive? Tendence says that people will often buy something that costs them less in fee. For example, people often prefer to spend, let's say, $15 on painting rather than $10 and $5 of shipping fee. Both are 15, but people don't like fee just because the word fee is it's negative generally. And the ease of use. How complicated is it to understand? People often won't invest in something that they don't understand or that they can't understand. So how easy was it for you to understand? And when you combine all of these, basically if all of these are positive, you can be sure, or you can be certain that the odds of the cryptocurrency being a good investment are higher than if none of these are respected. And I've pulled out these main points from the article I wrote on the SwissBorg blog, which is what are the best cryptos to invest in, which has been written at the end of March. So the cryptocurrencies that I chose probably aren't the best to invest in right now. It would have to be updated, but generally the theory is there. If you want to have a better idea of all of this, you can also read that. And now I'll hand over the floor to LSP for a matter of perspective.
Thanks, Ben. Fantastic. So we're going to be discussing technical analysis versus fundamental analysis, trading versus investing, anticipation versus confirmation, higher timeframes versus the lower timeframes, and others versus you. Now, when we did the original Smart Talk, I did an overview of these, and then in the subsequent Smart Talks, I took each one of these and I went in depth. So that's what we're going to be doing going forward. So technical analysis and fundamental analysis is something that's been discussed ad infinitum. It's always been this back and forth between those who are technicians or technical analysts and the fundamental analysts who believe, things like the news, and they use the news, PE ratios, companies, balance sheets and things like this to make investment and trading decisions. Whereas the technical analyst will look at charts, indicators, and focus solely on the tools of trading as opposed to the news of trading effectively. So what's the difference? The main difference between technical analysis and fundamental analysis is nothing. And this is something that kind of baffles people when I discuss the idea that there's really no difference, because you can be both and still be a technical analyst, or you can be both and still be a fundamentalist. Yeah, there's no difference between the two. The example that we can give here before we go to trading and investing is, if I'm looking to make an investment decision or a trading decision on an asset class, I will look at the chart as a technical analyst and I will say, okay, trend looks good, everything looks great. Maybe I use some indicators and say, yep, everything's looking like it's going to go up. Fantastic. But then I may also have a quick look at the news, and say things are kind of okay-ish. and factor that into my analysis. What makes it tricky is to understand is if a technical analyst is looking at the charts and a fundamental analyst is looking at the charts, then are they both not using the same tool? Yeah. So effectively, there is no difference between a technical analyst and a fundamental analyst. They both do the same thing. A technician could look at the news, and a fundamental analyst can look at the charts. They can do both. So trading versus investing, a very simple one to explain, a little bit trickier to go into in terms of psychology. But trading effectively is something that you do very quickly. Generally, you'll find that traders are in and out of the market. They're looking to increase the money in their account quickly, effectively, using the odds statistics, in their favor to get a favorable return. Whereas investors are in it for the long term. You will always find, as an investor, the investor is more concerned about the longevity and the strength of whatever they're investing in, and will it outlast everything else? Is it strong? Is it going to continue into the future? 5 to 10 to 15 years, possibly 20-year time horizon. Whereas a trader, we're not affected, and I say we because I'm discussing myself now, I'm predominantly a trader. I'm not really interested in whether or not, as a trader, is the company going to be around, in 20 or 30 years time? I'm looking at the next hour. I want to know, is this thing going up in the next hour, and can I capitalize on that? Okay. So it's effectively about time. There are some other elements involved, and we'll discuss those when we get to them. Anticipation versus confirmation. This is a very in-depth topic. Okay. But generally you will find when you anticipate an entry, doesn't matter whether you're trading or investing, as an anticipatory trader, you're anticipating your analysis to be correct, and you will make a decision based on whatever you're analyzing and the confirmation of that. But it will be an anticipation. You will jump into the market and say, I think that price is coming down into a level, and I give you a very simple example. Moving averages. Let's say you have a moving average on your chart, and price is coming towards that moving average, but it's moving away. Yeah, it's actually gone up, and then it starts to pull back, so it's moving away and going down. And you think, okay, it's looking like it's pulling in a little bit. I'm going to wait for it to touch the moving average, and I'm going to buy. That's confirmation. If it starts to pull back and you're about, say, 20 or 30 cents away, doesn't matter what you're trading, we'll just say 20, 30 cents away from the moving average, and you just buy because you're anticipating that it's going to react positively off that moving average, then that's an anticipatory entry, and it can get people into a lot of trouble. I personally went through this for years until I switched to a more confirmation strategy, which has kept me out of a lot of losing trades. I've missed some trades, yes, but the ones that I've been in have generally done very, very well. Higher time frames versus lower time frames, again, it's extremely in-depth topic, and one that I absolutely love discussing and talking about. But the higher time frames versus lower time frames, issue will always come down to this very basic fact. The higher time frames will always give you a stronger, more solid, more long-driven level, something that is going to hold more often than not, something that's going to last in terms of trend more often than not, and something that's going to continue. And as it's going to have a lot more weight to it. You have institutions, banks, hedge funds, and so on. When they're looking at charts to analyze the markets or whatever it is that they're trading in, or investing in, they're not looking at 1 minute and 2 minute timeframes. They're looking at big timeframes, weekly, monthly, quarterly, sometimes even 6 month timeframes, depending on how much data they have. This is good for us because when we're taking our trading levels or our investment levels, prices that we're looking at and really interested in off the higher timeframes, they will be so much more stronger on a higher timeframe. The lower timeframes, in this analogy or in this, this example that we're giving, generally tend to move extremely fast. The moves are not as drawn out. They don't last as long. There's not a lot of weight to them. And then a very good example is the 15-minute chart. Let's say you jump into the 15-minute chart and you're looking for a quick, let's say you jump into a 15-minute chart and you're looking for, a 2-week hold, for example. There's not really much going on a 15-minute chart other than intraday volatility. So you might go up, it might go down, you might be positive for a little bit, you might be negative for a little bit, maybe you're back at break even, but generally you're not going to get that nice, long, drawn out move with strength behind it. You're just going to get a lot of intraday volatility. So it's very difficult to enter an investment, especially investments, as opposed to trading. It's very difficult to enter, these longer term investments on a 15-minute chart and then hold for weeks and weeks and sometimes months and possibly even years just looking at the 15-minute chart, because you're going to get whipsawed and your psychology kicks in. You may panic, you may get out when you don't need to, and nothing's actually happened. If you take a full day on a 15-minute chart and then actually look at the candle on a daily chart, you'll see what I'm talking about. And then there's others versus you. This is purely psychological, okay? As a brief overview, what I'm really trying to get to when I discuss this, and obviously when we get to it a bit more in depth in the next however many smart talks ahead we will be, this is about you and you taking responsibility for the decisions that you make, having confidence in the decisions that you make, and in your ability to analyze the markets and so on. And it's all on you. At the end of the day, we all speak to others, about our trading decisions. Doesn't matter who it is. I'm sure you have close friends or people that you discuss your investments with or trading with, or just talk about crypto, Forex, whatever in general. And unless you have a very strong mind, a very strong will, and you're very disciplined, it's very easy to be swayed by somebody else's opinion or idea. So you may be out and about, you meet up with a friend, and you get to talking about whatever you're doing, in the crypto market, for example, and that person may say something to you, and we'll use CHSB as the example because it's our beloved CHSB, right? Let's say you're accumulating, everything's going great, and you're sitting on a loss, but you're quite happy with that because you have a lot of confidence and belief in the company and so on. But then your friend says, I read an article the other day about SwissBorg and, it was quite negative. And you're like, oh, can I see it? And they show you. And before you know it, by the time you get home from that meeting or that, outing with your friend, you're looking for ways to get out, and you're panicking because you want to get your money out, it's stuck in the yield and you've got to wait 24 hours. And this happens. So we will get more into this as time goes on, all right? So we'll move over to, I can't remember where we were now. So we've got others versus you. Yes, responsibility. Now, there's two things I want to discuss here. Pitbull, somebody asked me a long time ago in the Discord chat, it was in the Wealth and Trading channel, what books would I recommend, to read when it comes to trading and investing. And the only book that I've ever recommended anybody reads is Pitbull, by Marty Buzzy Schwartz. The book's phenomenal in my opinion. It's a book that's quite old, but Marty Schwartz for me, he was a futures trader many moons ago, and he was the first person that I really resonated with. He had no losing trades. I don't know, after he wrote the book or after, I've not really kept track of what he's doing now, if he's even around, but at the time, absolutely phenomenal trader, and you can learn a lot from this book. So I would definitely grab a copy if you can. I'm sure it's available, in some form of ebook. I don't know if it's an audiobook, but if it is, it would definitely be worth, getting the audiobook and having a listen to it. But definitely and highly recommended, Pitbull by Marty Schwartz. And the word of the week was responsibility. And we touched on this briefly when we were discussing, the matter of perspective, but responsibility is something that is at the forefront of every decision that we make, especially when it comes to trading and investing. We absolutely 100% have to take 150,000% responsibility. I really want to emphasize this. Responsibility for every single decision that we make, regardless of whatever the environment has done, whatever people around us have done. Even if you're in a trade and it gets halted and it's not your fault and you lose a lot of money, it doesn't matter. You pick the worst negative, thing that can happen to you in the market or has happened to you in the market, and I can promise you it was your fault. That's how absolute taking responsibility has to be. You may listen to that and think, well, actually, it wasn't my fault. And that may very well be the case, but I'm really trying to emphasize how taking full responsibility is so important, because when you do that, this allows you to stop putting the onus on other people, to stop looking or making excuses, stop looking for and making excuses for things that don't go your way. We've all had, situations where we've jumped into something and we've had a poor result. We're in an investment, maybe that it's not working out the way we expected. We may have purchased some, land or property, and that didn't go very well. We may have purchased a business, and maybe that's not going, as we expected. Shit happens, right? But the reality is, if we take full responsibility for what we're doing, this allows us to start asking questions. Instead of saying, oh, it was your fault, and shutting down, or this happened to me, it's not fair, we open ourselves up to the possibility to say, do you know what? I might have done something wrong here, or maybe I'm not as educated as I thought I was, or maybe I'm not as, smart as I thought I was. Maybe I need to start learning about this aspect, or maybe this or this or this. So this is extremely important, and something that going forward, if you just kind of have a think about it, and think about some of the decisions that you've made. We're talking about investing and trading, obviously, but some of the decisions that you've made, that didn't quite work out or weren't going according to plan, and break that down and see if you can find the moment where you stopped taking responsibility and actually did something about that negative problem, and broke it down in a way where you can start to look at where you may have gone wrong, the moment where it went wrong, and fixing that going forward, so you're not making these mistakes again, and you're growing as an investor or a trader. Yeah. So I'm going to hand it back over to Ben, and I just want to say thank you very much for everybody who watches these videos, and we really hope that you guys are learning and really taking from these, because we put a lot of effort and time. We put a lot of love into these videos. Take care, and I'll speak to you guys soon.
Perfect. Thank you very, very much. Here, the QR code is the link to LSP's YouTube channel. If anyone's interested, you should definitely scan this and have a look at what he does. If you've liked the format, we do this every Thursday at 7:30 on SwissBorg's Discord on live. If you want to follow up and ask questions and have the weekly CHSB analysis, I strongly recommend you to hop on there. It's both of us, it's the same format, and it looks even nicer. In hopes that you've enjoyed the video, we see you next time. Cheers!